G'day traders, welcome to part 3 of the risk models series. So what I want to do with this one, take I guess 30-40 minutes and just what we've learnt in part 1 and part 2 and just plug in some real figures and just take it and make a real example of it. So if you haven't seen part 1 or part 2 yet, I would suggest watching those first. Just because a lot of these things might not make sense. I'll go over them again briefly, but um, I guess it's important to understand the foundation and how to work out these formulas and where these formulas come from before seeing how them, actually how they work with real life examples. So I encourage you to do that first. Just to lead into it, as a quick lead in, we're talking about risk models, and risk models should be a major part of trading. It's really something that's a little bit underutilized. There's a lot of talk about actual system development and creating entries and things like that. But when you break it down and look at what professional traders do, and what I want to do is model myself on professional traders because they're the ones that make all the money. 90 as I don't know, you hear the figures, 90% of traders fail or something like that. It's retail traders, not knowing the best way to trade. Not because it's their fault, but just no one showed them how. Traders come and go all the time. But the ones that make this market move and the ones that are pulling, taking everyone's money and making it grow every year and every month after month, obviously the professional traders and people that are trading other people's money, fund managers. There's all sorts of professional traders out there, but I want to base myself on that and see what really works. And when you break it down, it becomes a lot less about the actual system, about the entry. Yes, that's important, but what's really important and really underutilized and figures are out there that you should really put a lot more emphasis on this and make it secondary to your entries, and that's creating risk models and creating the parameters around how you should trade or how you should manage your trades. And it's a major part of trading, and it's something when I started looking into it, it's just an absolute light bulb moment for me. I couldn't believe that I was trying to make it without knowing these sort of figures, and it just became so clear that with this sort of risk modeling, it's going to be a lot easier to move forward, and that's sort of the hump that I needed to get over to really start to move forwards. I'd suggest a couple of things. Google. There's abundant of information out there. Get your iPhone out and just Google some of these terminology, and you'll pull up some great segments from other traders. I've watched many of them about risk models. I suggest risk models, expectancy, R multiples. Google those sort of things. There's a book, Trade Your Way to Financial Freedom. Parts it's really heavy, and there's almost some parts of it, probably about a third of the book, that I'm almost just glazed over. It wasn't really relevant to me, but there is some absolute gold in that book, Trade Your Way to Financial Freedom by Van Tharp. Amazing book, and it explains this really well, and I definitely suggest looking into that. So that's just a lead in to risk modelling. Righto, so let's have a look at some real example. What I've done here, I've just taken the last 5 weeks. So this is a bit older now, so this is not literally the last 5 weeks, but I've taken 5 weeks out of my trades. It's not the best 5 weeks, not the worst 5 weeks, not like I've deliberately chosen every 5 weeks. Just when I drew up these figures, just happened to be the last 5 weeks of my trades, of what my trading plan produced, or my trading model produced. What I would say obviously with risk models, as we talked about in part 1 and part 2, it's about determining a couple of things, having a very systematic approach, and from that absolutely you need to know 4 essential things, and that's your strike rate, or what they call reliability. Okay, what percentage are you getting it right, and what percentage are you getting it wrong, and it doesn't really matter what that percentage is. Quite often that's the main focus in traders, and you'll hear from a lot of these books that I talked about before on professional traders that that shouldn't be the main focus. It really doesn't matter. What's more important is expectancy. What's your average winner versus your average loser? Okay, and then the third part is frequency. How often are you taking trades? Okay, it doesn't matter how often you take trades. Some people take a heap of trades, some take little, but it depends on the system and depends on how you approach trading. But understanding what is your frequency, how often do you take trades? Okay, and then fourthly, what's your maximum drawdown? So based on recording your last 6 months or 12 months of data and seeing what your worst losing streak was, almost multiplying it by 2, so you've got a situation where you completely understand what your worst case losing streak could be, and then once you work out your position sizing, which we'll do today. So you work out that you want to risk 1%, for example, every time you take a trade. Well, then you've already worked out what your maximum losing streak was. Let's say it's 10 trades. Well, you multiply that by 2, so you got a maximum losing streak of 20 trades. Okay, coming from a worst case scenario, we don't want to ever deal with best case scenarios. And if we realise that we should be trading 1% per trade, now that's just an example, times 1% by 20 losing trades, there it is. 20% is what our maximum drawdown potential is. It sounds bizarre to work that out, but what it is, it's really important that we deal with those sort of things and understand those sort of things before we start trading. That might be way too much risk for you, or you might be prepared to risk that and more. What I'm saying is, they're just some random figures, but understand some of these things which we're going to go through tonight and how they apply to you, and base them on your situation. Okay, and that's risk models. Okay, again, I just want to go over that. That's your strike rate or reliability, frequency, the number of trades you take, expectancy, which is your average winner times take away your average loser, and I'll get into that in a second, and then what's your maximum potential drawdown. Okay, so let's have a look at a few things here. Like I said, the last 5 weeks, so basically in brackets here I've got, from that there was 50 trades. This all adds up, 50 trades. I had 19 winners, 13 break even, 18 losses. Okay, I've just divided the last 5 weeks as well. This week here I had 1 winner, 2 break even, and 3 losers. So not the best week. This one here, this is a pretty good week. And so winners, break even, losses. So just that's not really important. I've just broken it down of what's happened over the last 5 weeks. Okay, we're talking about maximum risk, or what's our R? What are we basing our R on? So for me, my maximum risk is 5 ticks. I never take a trade worse than 5 ticks. Occasionally I might get a 6 ticker, but that's purely just from something that I've done wrong, slippage, not that really happens, but to me very often. But I'm not saying that I won't ever get worse than 5 ticks, but what I do is predetermine that my maximum risk is 5 ticks. So therefore, when I'm talking about, it doesn't matter what I make, whether I make 2 ticks or whether I make 100 ticks, my R value is 5 ticks. So what I'm prepared to risk 5 ticks, so that equals 1 R. Okay, so we went over that in part 1 and part 2, meaning if you, for example, make, if my risk is 5 ticks, if I take a 10 tick profitable trade, I've just made a 2R trade. I've made twice what I'm prepared to risk. Okay, if I take a 20 tick trade, I've made 4R, 4 times what I'm prepared to risk. Okay, the other thing I want to do is just excuse the handwriting as well. I did highlight a few things. It just hasn't come up as clearly as I thought, but I'll take you through and explain a few things. But for me, I just found this the easiest way to explain. I just want to make it as simple as possible to get the point across. So I found if I can just handwrite it out, scan it in, and show you this way. Okay, so 3 major columns here. This is the 50 trades divided into winning trades, center column break-even trades, right-hand column losing trades. Okay, and you can see each column. Oops, sorry, one sec. What happened there? Okay, you can see each column is then divided into 2 sub-columns. Okay, I should have put the heading up the top here, but I must have forgot. But all I've done here is on the left-hand side, that's my ticks. 10 tick winner, 10 tick winner. So what I made or lost in ticks. So this is winning ticks, break-even ticks, losing ticks. And then on the right-hand part of each of these columns, so that one, and that one, I did highlight them, but you can't really see them. I've expressed it in an R value. Okay, so let's break it down. So also I want to point out too, these ones in brackets. So what I've done is taken commission out. I always want to work out my real results. I don't want to not exclude commission, because at the end of the year, when you're taking 400 trades a year, of course, the commission is definitely going to add up. So I don't know if you've worked this out before, but based on the way we trade, every 2.5 trades, doesn't matter whether it's winner or loser or how big they are, how small they are, every 2.5 trades, you pay 1 tick in commission. So I find the easiest thing for me, just keep it nice and round, 2.5 trades. So I want to go every 5 trades minus 2 ticks. Okay, so basically when I take my 3rd trade, I'm just taking a tick off. When I take my 5th trade, I'm taking a tick off. Okay, so you can see there, roughly every 2.5 trades, I'm just taking a tick off what I made, and I'm getting my real figures based in figures after commission. Obviously over here in the losing column, I add a tick because here I've already lost 5 ticks. So this is my 3rd trade, I'm adding another tick on, so I've actually put this down as a 6 tick loss because I want to take in the commission. Okay, so that's taking the commission on all the trades. So here it's a 10 tick win, 10 tick win, 9 tick, 22 tick, 9 tick. You can see most trades I'm going for 10 ticks. It's a few 8s, a few 10s, 12s, 11s, one bigger win there. Occasionally have bigger ones, so it all works out in the long run as to add up to, there's 19 winning trades there that adds up to 192 ticks. Okay, and then expressed in R value, so 10 into my 5 tick risk goes 2. Okay, so it's a 2R gain, 2R gain. 9 ticks into 5 goes 1.8. 22 ticks into 5 goes 4.4. So this is my R. So basically I'm just working it out. So if I randomly pick a trade, this one here, I made 1.8 times what I'm prepared to risk. Okay, so when you look at it down here, 192 tick profit divided by 19 trades divided by my 5 tick risk, divided into 5 to work out my R, is 2.02 R. So what that means, that's my average winning percentage expressed in R values, and to me that means a lot more than ticks. Okay, or expressed another way, it's basically 10.1 ticks on average I gain. So that's just average. It's an average. Okay, 2.02 R, meaning every winning trade is an actual winning trade that I'm making, that I take, sorry, on average, I'm going to make 2.2 times 0.02 what I risk. You might times that by 5 ticks. You might times that because that's what I risk. Or if I risk $1,000 per trade, if that equals my 5 ticks, then it's 2.02 times 1,000. That's what I make in dollars. You can, if you want to set in dollars ticks, however you want, you just times it by that figure. But I'm making 2.02 times what I'm prepared to risk. Okay, so this is over 5 weeks. Obviously, like I said, the longer the time frame, the clearer and the more definite the figures are going to be, and the more reliable the figures are going to be. Okay, I've done the same thing for break even. A few 0 tickers, 1 tickers, pretty much, they just were winning trades, but they came back and ended up stopping out for break even. You can see this one here was 0, but I took off a tick for commission because that's just where it was in the order. So it's actually a negative 0.2 R trade. But when I break it all down, there's 13 break-even trades there for a total of 5 ticks in profit. So 5 ticks in profit divided by 13 ticks divided by that 5 ticks that I'm risking to get my R value equals 0.07. So basically all my break-even trades, I make 0.07 times what I risk. Obviously I'm not there to make money on break-even trades. They're free trades. They don't end up going my way. And then here's all my losing trades. So you can see, most of the time it's around about 1.8, 0.6, a few smaller losers there, a few bigger than 1R just because of the fact I've added a tick for commission. But all up, 18 losers, 78 tick loss. So divide that by 5 ticks that I'm prepared to risk, comes out with negative 0.86R. Meaning, if 1R is 5 ticks, every time I take a losing trade, on average I'm losing 0.86 of what I initially risk, which is 5 ticks, or expressed in ticks, 0.86 times by 5 ticks equals 0.433. So basically, now when I average out all my losing trades after commission and everything, my average losers are a little bit better than what I expect. It's 4 ticks rather than 5 ticks. Okay. Moving over to the next page here. So hopefully that's just a breakdown of the data. So what we're going to do then, I want to show you how I've come to this data and then put it into the formulas, and we're going to get some very precise models and mathematical scientific figures that we're going to use. Why would you take the time to hopefully you understand why we'd take the time to work all that sort of thing out. If you don't, it's fair enough. I'd suggest doing a little bit more reading on it and a bit more understanding about it. But for me, it's just becoming very clear and definite about the model. Anything in life, like especially business or even sports or anything like that, you've got to have a very specific plan in front of you, and you've got to base that plan on past results and what works. And then you can start to determine, of course, nothing ever is going to be exactly the same, but you can start to determine, with your model, roughly what you can expect in the future, and that gives you power, gives you confidence, gives you belief. It does amazing things for your mindset, which we showed in part 1 and part 2. Mindset's everything in trading. It's more than 50% of the deal. Doesn't matter whether it's trading, business, sports, anything. If we can do anything to build our mindset, and that's what this is doing, we're in a better place. Okay, so now I want to go ahead and remember, I've got the expectancy formula here again, but remember in part 2 we worked out some expectancy So what we're working out is, how often do we win, how often do we lose, and then we're multiplying that by average winner, average winner and average loser, and from there, we can start to understand what we expect from our trading model. Okay, so the winners, and what you want to do is, I've added all my winners. I've classified my winners as all my winning trades and all the break-even trades. Even the few here that I think there was one or two that were negative just because of the commission thing. I've included them as the winners as well. But what I want to do is, obviously we've got to put the break-even somewhere. Okay, we've got to understand what our winners are and what our losers are. Now, the reason I add them to the winners is because I want to operate, again, from a worst case scenario. I don't want to ever do anything that kind of makes the situation look better than what it is. I always want to make it look worse. So then, from a mindset perspective, I know that I've worked it out from worst case scenario, and I feel good about that I can only do better, so to speak. And when we're talking about expectancy, okay, the reason I do it this way is, expectancy is your average winner and your average loser. Okay, so by adding these smaller trades onto my winners, what that does is brings my average winning trade down. Okay, it makes my winners look smaller. And yes, it will slightly increase my strike rate, but I'm not too concerned about strike rate. What I put a lot more emphasis on is expectancy. So therefore, I want to add the break-evens to the winners because I want it to drag my down my expectancy. And that's operating from a worst-case scenario. I don't want to have my expectancy a little bit more better inflated than what I think it should be. Okay, so hopefully that makes sense. So I'm adding my winners and break-evens together. So that means, technically, these two columns is my winning column and this is my losing column. Okay, so there's 32 winning trades that were, either break-even or better, and there's 18 losing trades. A total of 50 trades. So that's, as far as strike rate, skipping down to this section here, just following the cursor, 32 winning trades into 50 goes 0.64. So I've basically got a winning strike rate of 64%, a losing strike rate of 36%. Okay, now I'm going to work out my average winning trade. So I've just taken my total ticks divided by the number of trades divided by my maximum risk. So again, it's 197 ticks here plus 5 ticks here. Okay, so it's 197 ticks in total divided by 32. That would give my average tick gain, but then I divide it by 5 because I want to work it out in R. So basically, I've just taken the 0.02R and 0.07R, added them together, divided by the number of trades, obviously, and all of a sudden, then you can see here that's dramatically dragged down my average winning R. Now I've gone from a situation where it looks like it should be about 2R to my actual winning R is now 1.23. Now that's what I want to do. I want to bring it down and make it worse than what a worst case scenario. Okay, because when I plug in all these figures and work it out, the end result, I want to know that that's the way I did it. Okay, so now I've got an average winner of 1.23R when you express it in RV. So that means every time I take a winning trade, I'm making 1.23 times what I risk. So if risk is 5 ticks, so 1.23 times by 5, what that add up to be is about 7 ticks roughly is my average winner now, rather than 10 ticks. Okay, and then the same thing for losers, 78 ticks divided by 18 trades divided by 5 ticks, and it's the same figure as here. My R loss is 0.86. I lose 0.86 of what I'm prepared to risk each trade. Okay. Now expectancy. I won't go through it now, or maybe I'll give it a real quick analogy. That book I talked about before, Trade Your Way to Financial Freedom, talks about basically did an analogy of what expectancy is, and rather than talking about figures, he talked about a snowball fight. And if the wall in front of you, okay, you imagine this wall of snow in front of you, that's sort of like your capital base. The bigger the wall, the better. But then, the snowballs are being thrown at your wall. Okay, there's two types of snowballs. There's white snowballs and there's black snowballs. Basically, the white snowballs, they stick to your wall. They make your wall bigger and stronger. Okay, so the white snowballs are your winning trades. The black snowballs, they knock holes in your wall. Okay, so it's knocking down your wall. So obviously, the more black snowballs, the worse off your wall's going to be. So what expectancy and strike rate and all this takes into consideration is, you could have a lot more black snowballs coming at your wall, but if they're little black balls, and you've got these big white balls, and they're winning trades, and they're making your more solid. It doesn't matter if there's more black snowballs than white snowballs, as far as you could have a worse strike rate of 40%, but your expectancy quite high, meaning those white snowballs are bigger. It really starts to add to the situation. So that's a very quick overview. I'm not sure if that really helps the situation, but it's just an example of why expectancy is so important. It's not all about strike rate. Okay, but what we want to do is combine them all together and have a figure that really helps us. It makes us a better understanding as far as what we're doing with our trading. Okay, so expectancy is your winning percentage multiplied by your average winning trade. So you worked out what is your average winning trade. So we've worked out, based on our break-evens and our winners, that we stand to make 1.23 R. So that's our average R gain. Then we want to take away from that is the number of times we lose multiplied by our average R loss. We worked out at 0.86. So here it is here. So our winning percentage, 0.64 times by 1.23, gives us 0.78, and then 36% as far as when we lose times by our average loser gives us 0.3. So what that just takes into consideration is it says, okay, we've taken your strike rate into consideration, and based on that now, the fact that in this particular case, winning a little bit more than losing means on average when you win, this is how much you're going to win, 0.78 of what you risk. But when you lose, you're only going to lose 0.3 of what you risk. You take that loser away from the winner, and gives me a 0.48 R. I've got here, big deal. This is everything. Okay, what that means is every single trade I take, on average, because it's an average thing now, I stand to make 0.48. So let's just call half an R. I make half of what I risk. Okay, so if I risk 5 ticks, I stand to make 2.5 ticks. That's every trade. Doesn't matter whether it's a winning trade, losing trade. Obviously, we're talking on average over the length of time. That's what I stand to make, and I've got that down here. If I risk 5 ticks, that equals 2.4 tick gain every trade. So then you just multiply that by frequency, and you're starting to get an idea of a return on investment, which will be the next page. So, for example, if I'm making 2.4 ticks every trade, and I'm taking 10 trades a week, I stand to make, what's that, 24 ticks every single month, or every single week, sorry. But what I'm doing now, I'm getting to a situation where I understand these figures based on, of course, like I said before, it's best that it be based on 6 months or 12 months data, or 100 plus trades. Just doing something based on 5 weeks is not a big enough sample size. But this is just an example. You can imagine if you work this figure out over an entire year, and you've got a very systematic approach, and of course, as we said in previous parts, you need a very systematic approach to be able to work out these figures and be consistently taking the same areas, so then you know that you can have, you can pretty much rely on these figures that you previously worked out because you keep on taking the same areas. Okay, and based on this, you've worked out that every time, taking everything into consideration, how often you win, how often you lose, the size of those winners, the size of those losers. All that happens is if you keep on clicking that button, keep on doing what you're doing, you make half of what you risk. Or in my particular case, 2.4 ticks every time I click that button and take a trade. So it's power, again, it's power and belief, because you've worked out your trading based on a model. And this is absolutely important. Like I've said in one of the other parts, if you don't know expectancy, you don't know these figures, it's going to be very hard to get ahead, because you're missing a major part of the puzzle. I soon realised that for myself. Is that when I started reading through this, I was like, oh, light bulb situation. It just makes a massive difference, because I understand a lot bigger part of the picture. All of a sudden, it's like like I said, entries or the actual system's only 10% of the puzzle. It's like I'm trying to make it, but I can only see 10% of the situation. Then all of a sudden, my eyes were open and I could see the whole situation, or everything that what it takes to be a winning trade. It's like, I only had 10% of the winning formula. Now I'm given 100% of the winning formula. Oh, great. Now I can go ahead and do this. But of course, it takes time. It takes a lot of work. This is not something that happens overnight. It's going to take months, maybe even years. But of course, it's worth it. So what we're talking about here, return on investment, is just an expectancy times by frequency. Okay, so return on investment in a month, 0.48 of what I risk on every trade. That's what I'm making. You times that by 40 trades. based on what I said before, I took 50 trades in 5 weeks, so on average that's 10 trades a week, so 40 trades in a month. Pretty easy work out. 0.48 times by 40, that equals 19.2 R. It's not necessarily 19.2%. 19.2 R means I make 19.2 times what my initial risk is. So 19.2 times 5 ticks. What does that actually mean? Well, you can work it out in percentages, obviously. If my risk is 0.2%, every time I take a trade, my maximum risk is 0.2%, well, 0.2 times by 19.2 equals 3.8% return a month. Now, there's going to be some months bigger, some months smaller, but when you average it all out, that's what it adds up to be. Just reduce that. There we go. Done the same thing for 5.5%, 1%. Whatever you risk per trade, just times that by Aave, and that gives you a return on your monthly value. Okay. So then we've worked out expectancy. That's one of the tougher things to work out. The things will take a bit of work and a bit of effort. So now we've worked out that, what we can then do is go ahead and work out what we should be risking per individual trade. Like I said in part 1 and part 2, you need to work these things out based on you as an individual, your circumstances, your account size, your personality. It's no good just to have some sort of figure that someone else told you, or maybe something you just plucked out of the air, which is certainly what I did to start off with. But then it was all about taking responsibility and finding these things out for myself. And of course, when I did work these things out, like I said, that's what gives you some real power. It gives you power and belief, and it really encourages you to push on. Okay, so this is the formula, and we broke this down quite a bit in part 2 in the previous session, but let's go through it again. Annual objective. So what do you want to achieve in a year? That's something you can work out right now. Have a bit of a think about it, and we kind of elaborated on that in part 2 as to what kind of figure you'd have there. I think somewhere between 50 to 150%, somewhere around probably close to 100% is a good annual objective. Okay, so annual objective equals trade frequency multiplied by position size multiplied by expectancy. Okay, so we know annual objective, like I said, it's your personal decision based on goals, risks, circumstances. We know trade frequency. Okay, if you have a rough idea, that's a great place to start, but work out a more consistent figure, because as you know, we have slower markets, fast markets, but you want to work out something that over a greater sample size will give you a pretty good average. Okay, so then just take whatever it is, your average trades per week, multiply by the number of weeks you trade a year. You might trade 30 weeks a year, you might trade 40 weeks, 50 weeks. Give yourself a few weeks holiday a year, obviously. For me, roughly, it's 10 trades a week times by 44 trading weeks in a year. I have 2 weeks off. I want to allow myself a few weeks off in the middle of the year, and then obviously big break over the Christmas New Year. Expectancy, we're just taking the time to work out that our expectancy is we stand to make about half of what we risk every time we take a trade, and the position size to be determined. Okay, so let's plug all those in. Here they are here. Annual objective equals trade frequency times by position size times by expectancy. Those are in brackets. Okay, so 100% per annum is an annual objective I go for, equals 440 trades per year, 10 trades a week times by 44 weeks, times by position size to be worked out, times by expectancy, which over the last 5 weeks is 0.48. Now, just a matter of algebra. First of all, let's get rid of trade frequency, so we divide both sides by 440. So 100%, or 1, divided by 440 equals 0.0022. So 0.0022 equals position size times expectancy. Again, let's get rid of the 0.48 so we can work out position size. So divide both sides by 0.48. So 0.0022 divided by 0.48 equals 0.0047. So that equals position size. So position size, when you bring the decimal place back a bit and work it out in percentages, equals 0.47%. So 0.47%. So that's basically half of 1%. So I should risk 0.5% per trade to gain 100% per annum based on my model. Okay, so 0.5% per year to gain 100% of the model. So stopping for a second and looking at the different elements of, let me bring it up 1 second. Okay, here it is here. Just stopping for a second just to go, okay, what have we got as far as our risk model here, and what are we doing as far as determining everything we need to know? You know, there's four major things, and if you take anything out of it, just think that you've got to achieve these four things. It's an absolute must to make a success of trading. Okay, those four things are, I should actually write them down here, make it a bit more clearer. Reliability. Actually, I'll write them all out and I'll come back. Okay, sorry, I just took a second there. It's basically, excuse me, it's basically these things here, but just made it a little bit more clearer. So there's four things that are absolutely must of a risk model. Winning, losing percentage of your method. So that's down here. That's called what we call reliability, or your strike rate. Like we said, that's not everything about trading. When you first come into trading, it's almost like that's all it is about, and you've got to get to a situation where you're getting 60, 70% of your trades right. Yes, there's many successful people that do that. There's also many successful people that get their trades right 30% of the time and make a ton of money. Because of course there's a lot more to the the formula, expectancy, frequency, and things like that. Okay, but it's an absolute must as far as working everything out as to what is your strike rate, because then when you're multiplying that by your average winner, then we're starting to get a bit more of an idea of how you're going. Okay, so that's reliability. Now you need to know expectancy, so that's these 2 points here. What's your average winning trade? When you win, what's your average winner? When you lose, what's your average loser? Expressed in RBAs, which we did earlier on. Okay, that's expectancy. That's a big one. I'd say that's the biggest of them all. Okay, just really understand that and have a figure in your head and understand what does R mean. Like, do you hopefully really get when we worked out before 0.48 R. So basically half an R is what this model is expected to make. Expected to make. Okay, so whatever I risk, every single trade, I'm expected to make half of that. Doesn't matter whether it's win or loser because we're taking that all into consideration. So I'm risking 5 ticks every trade. I'm expected to make 2.5 trades every time I click that button. Okay, frequency. So obviously we times expectancy by frequency. That starts to give us more of an idea on return on investment. Then maximum potential drawdown. So we talked about this in part 2. So taking that away for a second, and what I want to say here is, based on position sizing and my annual objective and taking everything into consideration, I should be risking 0.5% to gain 100%. But there's another thing you got to think about. Just to make sure this fits the scenario, work out your maximum drawdown. Okay, because you don't want to be in a situation where if you're going for a couple 100%, you worked out what you should be risking. Maybe that figure's a lot higher, 2-3%. But then you start multiplying that by your potential worst losing streak, and all of a sudden you start getting a situation where you could be losing 50% of your account. Can you handle that? And you need to deal with that before it happens. Okay, so let's say my worst losing streak is 10 trades. Okay, 10 losers. That's very possible. That's nothing ridiculous as far as if you've got a system that gets it right half to 60% of the time. I can definitely have a 10 losing trade scenario. So multiply that by 2. I always suggest multiply it by 2 to cover your worst case scenario, understanding that the worst could still be to come. Now again, it's all about just operating from a situation where it's just worst case scenario, not best case scenario. So let's say 10 losing trades is my worst losing streak over the last 12 months. Times it by 2, so now I've got a situation where I'm basing this on 20 losing trades. So I feel real comfortable because I'm now knowing that I've worked out that I shouldn't ever be in a situation where I lose more than 20 times in a row. Okay, times 20, that figure I've worked out, 20 losing trades by 0.5%, that equals obviously 10%. So am I prepared to go through a situation where I could risk 10% of my capital to gain 100%, and am I comfortable with that? Okay, and that's where maximum drawdown comes into it. Okay, so this is the next page. So we basically worked everything out now: expectancy, frequency, return on, maximum drawdown, and of course strike rate. Okay. So just to finish off, just calculating some return on investment figures, so you can start to work this sort of thing out. So, objective is 100% per annum. Expectancy is 0.48 of an R. I'm taking 10 trades a week. And now I've worked out based on science, based on math, based on actual figures, nothing that just I've plucked out of the air that I've worked out I'm comfortable, and it's very mathematically based that I should risk 0.5% every trade. So, if 0.5%, of $100,000 account, what's that? So $1,500 is what I should risk. So, you take $500, divide it by 5 ticks, you can work out what you should risk per tick and then work out your contracts. Okay. So it should be a situation where when you have a 5 tick stop out or whatever your maximum stop out is, that equals 0.5%. That's what I've worked out for myself. So calculating monthly return on investment based on expectancy is this is how I break it down. I make nearly half of what I risk based on expectancy. Okay, so whatever I'm going into a trade with, remembering I'm making half of what I 0.48, so let's call it half what I risk I'm making every trade I take. Okay, so if I work out that 5 ticks for me is $1,000 risk, every time I click the button I'm making $500. Okay, so I make 0.5 times by 0.48. So what I'm doing here is just going back to a situation like where was it? This one here. We've worked out our monthly R. Okay, so you take your expectancy times by frequency, that gives you monthly return, okay, based on your risk. But then, as far as a percentage return on investment, that really comes back to what we're risking per trade. Okay, so you're just taking your expectancy times by frequency, multiplied by what you risk per trade. Okay, this is what I'm working at now. Okay, so let me go back to where we were. Sorry, let me find it. Where is it? Here. So I make 0.5. That's what I risk per trade. Okay, I'm risking 0.5%. I want to multiply that by my expectancy, and that gives me 0.24% every trade I take. Okay, so if my risk is 0.5% per trade, that's what that is, 0.5% per trade. I'm knowing that every trade I take, I'm making half of what I risk, which is 0.5%. Hopefully you're keeping with me. Obviously that's about 1/4%. That's what I've worked out. Are you with me there? 1/4% is what I make every trade. So what I'm just working out a situation. Again, we want to come from a situation where we don't care about the winners or the losers because we're basing it on risk models. Okay, we're not in a situation where we feel good because we're taking a winner or feel bad because we're taking a loser, and we're going through these emotional ups and downs. Of course, that's a hard thing to get over. It's not like I deal with that. I try to deal with that every day, and that's what that's what I really base myself on. It is dealing with that situation. And if I create these models where I understand that I've taken into consideration winners, losers, strike rate, everything, and based on pure facts, I'm in a situation where every time I click that button and take a trade, I make 1/4%. So I want to try and deal with it. Get rid of the winning and losers. I don't care because I know it all averages out to make me 1/4% every time I take a trade. That's based on fact. That's based on pure information. Okay. So if it's 0.24% every time I take a trade times by my frequency, 40 trades, I'm making 9.6% a month on average. 9.6% a month. Okay. Just to finish off, hopefully you're with me, and this is a lot to take in on board, and by all means send me an email or anything if people want more information about it. I really suggest getting on Google and developing yourself more and finding more information about it. I just kept on listening to it over and over again until it became like clockwork. And once you start to do it a little bit, give it a few weeks and you'll really get this concept. Of course, it's going to take months to implement it, but as far as understanding it, hopefully you understand it now. If not now, just keep on working on it and you'll get it in a few days, few weeks. Okay. So what can we take from this? A couple of big things. This is my big factors that I take from this. This is what it's all about for me. First of all, spoke about this right at the top of the session. You need a very structured, systematic approach to these markets, and the confidence to be taking the same trade after trade. Obviously, if you're very discretional, it's very much based on you, then it's going to be tough to get these figures out because every time you take a trade, you might be taking. You come to the market every time you go to trade. You feel good, you feel bad. You've had no sleep, you've had lots of sleep. I mean, if it's really about you, you're going to be finding yourself taking different trades all over the place, and it's a very discretional situation. Well, then you're not going to have confidence in these figures because you know it's about you. Okay, and I once heard that you really need to view, and I really take this on board for myself and think about this all the time. I need to view my trading as the model that I've created, not me. If you're in a situation where it's all about you, you're in trouble, and that's how I used to trade. So I want to be in a situation where I'm just there to execute the model. When the model says trade, I trade because I've done all the work and done all the work out the figures, and it's in my best interest to trade that way. A good gauge as to how systematic your system is can you give your system, explain it to someone else and they go away and get the same entries? Is it that clear that someone else can trade it? Or is it, that sort of, if it's really discretional, someone else is not going to be able to take your system and trade it, are they? So think about that. Can someone else take your system and be able to understand it and implement it? Okay, and it's very important, obviously, to have that because otherwise risk models aren't going to work unless it's structured and systematic. And I think a good example of that in the trading room is the 5-minute trades and the 5-minute fades. The arrows come up. That's a very basic example of it. But the arrows come up, and you know that within a week there's normally anywhere from probably 2, 3, 5-minute trades to sometimes it's 6, based on how active the market is. You average that over a year, you're going to get something like 3, 4 trades a week. It gets it right about, if you worked it out, probably 50% of the time. The winners are about 8 ticks, the losers are 5 ticks. You can be very confident based on the last 12 months of data. You work out you got an expectancy of about 0.3, you got a strike rate of about 50%, you got a frequency of about however many trades a year. You can really work out a really good risk model based on those 5-minute trades and fades. So that's the sort of thing I'm talking about. Whatever you do, but is your system as clear as that? And is your risk model that you're going to create as clear as that? Okay, so that's the first thing. Second is, like I've said, there's work involved. Obviously, there's work involved. But this is $1 million business, or whatever you want to achieve out of it. Most people are in it to create $1 million business. They want to create a pretty good income out of this. When you look at your trading system and what you do in your business, because this is your business, is it $1 million? Does it look like $1 million business? Okay, so there's work involved, and obviously it gets easier. But to start off with, it takes months or years of really getting everything in place, and then once the work's done, it's sort of you can get to a situation where you can cruise a little bit more. I find I look really forward to the day when I can kind of just settle down a bit and know that's all been done. But for now, it's just a lot of work and going like frantic and just putting every minute I can into it. But I think that's what business takes. Takes that sort of thing. And of course, 2 parts: a systematic approach, an absolute systematic approach, and more importantly, also my eyes are open to this fact that I need a risk model, and that is the perimeter that I put around my systematic approach. So we need to create those things. Okay, and when you create all this, what will happen? What will happen? It builds belief and confidence that's backed by facts and maths. I've never felt more confident than when I started doing risk models. I love trading, I enjoy trading, I put time and effort in trading. I backed myself, like you guys do. You have confidence, but I just had a system, and that wasn't enough. And when I used to think about bigger contracts and think about the end result, it used to make me a bit anxious. But it wasn't until I really started creating risk models and just understanding it from a pure math perspective, and even reducing risk as I get bigger and bigger, that I now really have a lot of confidence and just really look forward to getting bigger and bigger, because I know I can withstand that pressure because I'm building a solid foundation. So absolutely, this builds beliefs and confidence. And it wasn't until I looked into risk models and understood what the bigger picture and what the professionals do that I could really start to really extend on that confidence. Okay, and obviously then that builds mindset and makes you look at trading in a completely different way. Like a business, and you're able to handle the losers. When you first get into trading, it's just all about avoiding losers and taking winning trades. And can I take a winning trade? Feeling good when I take a winning trade, feeling crap when you take a losing trade. But that business shouldn't be that way. It should be all about a model. Losers are just part of the game, part of their costs to creating winning trades. And if you bring all these sort of things front and center and deal with them now before they come, then life is a hell of a lot easier. That's what I found for myself anyway. And absolutely, that builds mindset. And what's the number one factor becoming successful in anything in life is mindset. And this all absolutely kind of channels to building great mindset. And that's that's what it's all about for me, is mindset. And following that, I just got to figure out a little thing there. What if you change the figures and the outputs? So not the system. So going back to sort of page 1, what if, for example, I'm taking the exact same trade, so entries don't have to change. Okay, so all these exact same trades still occur. My 50 trades here, but I actually use spreadsheets and things to work out, okay, what if I had pulled out some of my contracts at this point, or let some contracts go more, or if I automatically take contracts out at 1R, so that way some of my break evens or even losing trades I'm making more on, and then obviously that decreases your winners a little bit, but you work out based on your situation what's best for you. That's what we talked about earlier. So then your expectancy starts to rise, or increase or decrease. Strike rate increases, decreases. Exact same trades are being taken, but your profit, you can two people can take the exact same trades, but depending on how they manage it, how they create their risk model, they could be light years apart as far as their returns. Someone could create profit, someone could actually have a losing year based on what you do with the figures. So that's where, two things that you can get absolutely so creative with this sort of thing. And just to finish off, I want to bring up a quick few spreadsheets as to how I record this information. So I'm always doing the best thing for my end result. And then the second point is, this is where it became obvious to me that I was focusing on the wrong thing. I was focusing on the actual system when managing the trade, like I said, it is I don't want to put it in a box, but people tend to say at least 3-4 times more important. Just meaning that risk model should come first, and then your system comes secondary to the parameters that you've created, which is your risk model. So when you can see that, it doesn't really matter the trade you take, but how you manage it can completely change the result you get at the end of the year. That's why risk modeling is so important. So what if you change some of those figures? So have a look at that and play around with that, and then from that, what you need to do as far as understanding these figures is set yourself up, create some spreadsheets where you can, every single trade you take, record this information. So it doesn't matter, I mean, you took the trade, record what you did for the trade, but record a situation. For me, for example, let me bring up an example of this. Here we go. Here, so I've got a spreadsheet, where, I mean, it doesn't really matter what all these columns and things like that mean. Basically, just for something to bring up while I'm talking about it, I've got a spreadsheet where every single trade I take, so I've got 6 different specific setups that I take, and then I've got the result I pulled out of it. But then I also want to record where it potentially, if it was a winning trade, where it potentially could have went to, and then if it was a losing trade or a break-even trade, what I'm really interested in is what it got to before coming back. All of a sudden, then I look over all my trades and I notice that most of my trades go 5 ticks or more. Then I'd be very interested in pulling, making sure I pull out some contracts at 5 ticks. Or I find a lot of my trades just keep on going past 8 ticks or 10 ticks. Then I maybe look at having a third of my contracts or some of my contracts going for more. Be in a situation where you're set up for good luck, meaning if you just let some of your contracts just go and go and go, for some of those bigger moves, and then that's going to, you have a few of those bigger winning trades, that's really going to change your expectancy at the end of the year. But don't ever do anything just on guessing or what you think's best for yourself, based on actual facts. So record this information, and then over time, over 6 months, go back over it and then plug in some figures and work out some figures and do a few scenarios for yourself and work out what's the best way to approach it. Hopefully that makes sense. Basically, you're just recording everything to find your best case scenario. Okay, and what's this one here? Performance table is going to take you through. This is just basically recording what happened, and you can get so creative with Excel and put these fancy little charts in, so you map out what your profit and loss looks like and things like that. That's all I want to bring up there. It's just individual trades and what you're making per trade, but get a bit creative, a bit fancy with yourself if you want. I mean, everyone's different the way they approach it. I like to be able to go back and see exactly what's happening. But I think more importantly is that other spreadsheet, recording exactly what's happening so I can take that information, plug it into my expectancy models, my annual objective models, and work out exactly what's best for my bottom line and for me making profit every year. Okay, so hopefully you got some things from that. That's the end of the 3-part series as far as risk modeling is concerned, but really take it on board, develop with it, run with it, and I think you'll be really glad you did. Talk to you guys soon.